Thank you, George. I have a bad habit of walking around. I like to have eye contact with people, so I'm not going to go up there because my wife, she tells me I'll stumble or whatever, but I'm pleased to be here. You know, it's this business, the investment business is, needless to say, phenomenal. It is my passion, and probably should be your own passion as well, because it comprises everything. Not only mathematics and investment, but also psychology, history, but more importantly, more than anything else in this business, it's common sense. And you can't learn common sense in university or school. Either you have it or you don't. What I'd like to do today is talk about the real world. And George, you may throw me out after I talk of various secrets in the business, whatever. Not to say there's anything untoward, but we like to call it as we see it. While at Wharton, I studied under Harry Markowitz. He taught me, he was the father of portfolio theory, and he won a Nobel Prize in 1991 in economics. And while he was a terrific teacher, I'm not quite sure what I learned. I also studied under Marshall Bloom. He, along with Irwin and Gene Crockett, wrote that dart throwing. And George and I chatted over lunch. The markets are imperfect, contrary to what they taught me in business school. Darts ain't going to do it. It's hardcore fundamental analysis. So the bottom line is, if I had to offer you any words of advice, study hard here. Learn all about the theories and formulas that you pick up in school. But it's clearly the school of hard knocks. You've got to learn, and the only way you learn is by making mistakes, and learn from those mistakes. When I was 23 and I graduated from Wharton, and I went to work for Hodson, Robert and Lang, they gave me a $250 million portfolio to manage, bonds. I didn't know the first thing about bonds because at Wharton they never taught us about bonds. The only bonds I knew of were Canada savings bonds. Now I might have been, you got to make a few mistakes. I learned very quickly. I have a quick learning curve, and that's the beauty of this business. If you've got a bit of street smarts and you're willing to learn, it's a great business. So, a little anecdote. When I was going to Wharton, I worked in a fraternity house for 2 years as a waiter. And I worked for Sparky MacGyver, a black Irishman. He was the cook from the ghettos of Philadelphia. And Gene Ross, who was a part-time Baptist minister. And I learned more from those two guys than I did at the school. And I'm half facetious, but I'm not. In the course of taking all my finance studies, Sparky asked me one day, so what are you doing at this fancy Wharton school? I said, well, I'm learning how to pick stocks, and you analyze, and you pick a stock and you call up your broker. He says, well, then what do you do after you speak to your broker? I said, well, I tell him how many shares to buy, and in 3 or 4 business days, I have to pay him the money. And he said, so what, you write a check? I said, yeah, good hard-earned money. And then he said to me, well, what do you get in return? I said, I get a piece of paper, a certificate. Well, it was the deepest baritone belly laugh I ever heard. He called me a moron. And actually, you give your hard-earned money, and he wasn't so wrong. The fact is, in today of the Enrons, the WorldComs, the Martha Stewarts, this business is a leap of faith. When a president of a company comes in to talk about a company, his company, my office, naturally he's going to put his best foot forward. Invariably, he likes to gild the lily a bit here. So, for instance, when I look at an annual report, I look at it backwards. I look at the notes to the financial statements first, then I go to the front. Because, as you know, the first 2 pages are the president's report. And naturally, he may only own 1 or 2% of the company, and he's going to try and feather his own nest. He's going to tell you all the good things that happened in the company, and he's not going to talk about all the bad things that he's doing. And why should he? He's got stock options, and he wants to ensure that he stays in power. I'm going to refer you to 2 quotes of Warren Buffett, and then I'll tell you a little bit what we're doing. I'll use our agenda. There are a lot of theories on Bay Street and Wall Street right now, and I guess you've all heard about EBITDA. I call it EBITDA. And in his 2000 report, Warren Buffett, to the shareholders, he said, reference to EBITDA make us shudder. Does management think the tooth fairy pays for capital expenditures? You know, you can look at EBITDA everywhere, but it means nothing. It's whether you have the do-re-mi. It's cash flow, cash flow, cash flow. And we'll talk about that a little later. The other thing, I cut out of the Globe and Mail last week. There's an article on Warren Buffett. As you know, he's looking for a replacement of himself. Anyone here applying? The next Warren Buffett, here's your chance. And it was interesting. There are a couple of points from the article. It says here, this is Buffett speaking. Temperament is also important, Mr. Buffett added. Independent thinking, emotional stability, and a keen understanding of both human and institutional behavior is vital to long-term investment success. I've seen a lot of very smart people who have lacked these virtues. So in spite of the fact you're going to take all these fancy finance courses, you've got to have the right psychology, the right temperament. I've seen guys who've been terrific analysts, but they come home, they can't even have their hand is shaking. Right now, the market is fraught with incredible volatility. I'd say many people cannot stand the volatility. You question yourself, your footsteps, you have rabbit ears. The bottom line, not everyone is meant for investing. The other interesting comment that Buffett mentioned, he is an extraordinary person to be able to invest intelligently and run the business intelligently. And they're two very different things. So the bottom line is this. It's one thing being a good manager, but another thing entirely to be a good manager of a company. You have to differentiate, which leads me to one of my things. I have to differentiate between liking a company and liking its stock price. I will invest in a company at $10. I love the president. I love the company's business model. Stock goes to $20, which is my target. And I decide to sell. Why? I still like the company. I still like the president. I may feel like Benedict Arnold in selling the shares because I become friend of the president. We'll go golfing. We'll go out for dinner, our wives and us. But the fact is, you have to differentiate. And this is where you have to be as cold and as cruel as you can be. Because one thing about the stock market, it's dollars and cents. And this is where you have to separate the emotion from investing. Okay, in terms of what we're doing, I'll refer you to our agenda sheet. We're a small firm. I'm a fourth-generation entrepreneur, and I learned a lot from my late father, who was a grocer, because what we do in our business is no different than running a corner 7-Eleven or whatever. It's keeping your expenses down. It's making rational, common-sense decisions. We're a small firm, and we manage now about $1.5 billion. We're 7 employees, including myself, and I have one of your former students working for me now. The bottom line is we're an equity research boutique. What we've done, we've farmed out all of our administrative duties to our Royal Trust, now called RBC Dexia. So all we do all day long is analyze balance sheets and income statements. We'll go on conference calls. We'll look at the internet. I look at brokerage reports, and off the record, I'd say 4 out of 5 are garbage. By the time they're in print, they're completely out of date. And I'll say this, that generally I like to look at companies that are not followed. And interesting statistic, 45% of public U.S. companies have no analytical following whatsoever. 0. That is nirvana to me. That's where I find the cheap stocks, before they've been discovered. Without sounding too much of ourselves, we're probably doing what Warren Buffett was doing back in the 1950s when he was small. Except I want to stay small, because it's quality of performance, not quantity. Whether I manage 10 or 15 or 50 billion bucks means nothing to me. It's having good performance. It's the passion. It's my name on the front door. I've got the most to lose because I have my whole RSP, along with my wife's RSP, in my funds. I'll let you in on another secret. I manage other people's money better than my own. You might ask why. I've cut away the emotion. When you're managing your own money, you worry about every little teeny. You know, you bought it at 10, you want to sell it exactly at 15 because you want to say, I made 50%. And so it's very emotional. When it comes to managing other people's money, it's not that I'm that more responsible, but I worry because there are a lot of people who are in my fund. They've entrusted me with their wealth. So if I think it's expensive, well, let me go backwards. If I think it's cheap at 10, I got to like it at 9.95 or 9.87 or 10.05, and I just buy the pants off it if it's cheap. Correspondingly, when it reaches our target level, and whenever I buy a security, I make sure I have my target price in mind. Now, that may change over time, but you have to know what you're playing for. And keep in mind that, we can have a bad night, a bad year. I mean, because Chris Bosh isn't, scoring a lot of points last week doesn't mean he's suddenly gone bad, or Wayne Gretzky years ago. The bottom line is we all have our off nights, and you're going to make mistakes. So you have to be in tune. You have to knock out a lot of the psychology. And this business is one word repeated 3 times. Research, research, research. It's one of knowledge. For you to make a multi-million-dollar investment decision, you have to have the information. If you don't have it, it's like milking cows by candlelight. You just can't do it. So what we're 5 analysts, including myself. We're all line people. And if you ever see my office, it's one big area. It's like it's a little gymnasium of 2,700 square feet. We will have 10 impromptu meetings during the day. If we see an anomaly forming in the marketplace, it may last a minute, it may last 10 minutes, it may last a day, it could last a week. We stop everything, we analyze the company, because a broker may call us with a big block of stock, or suddenly some institution wants out for whatever reason, and we'll do our work, and if it makes sense, we buy it. We're focused. We have a decisive sense of urgency. I used to work in New York. There are hundreds of guys like me in New York. In Canada, there are fewer. I mean, we're 1/10 the population. But the bottom line is, particularly today, with the internet, with instant information, and by everyone being so sensitized to the stock market today, you've got to be one up on everyone else. What we did about 10 or 12 years ago, I resigned all of our segregated accounts, and all we manage are the ABC funds. I rationalize as an entrepreneur, as a businessman, less is more. What do I mean by that? I'd sooner manage less money to make more money. To run a company like a puppy mill, to just churn out puppies like crazy, can't do. You're going to compromise a lot of things. Your performance, your ethics, your principles. Now, ethics is very strong in the business. Look at this. I even have my phone ringing now. It's a great business. You get one shot. And ethics, eventually you'll probably take it, if not in business school, you'll take it with the CFA course. And you'll learn all about things which should and should not be done. At lunch, you asked me about backdating options. To my knowledge, George, there's no law against research in motion giving people options backdating it about a year ago. There will be a law shortly, because a lot of people assumed no one was doing that. Because ultimately, when I look at a company and a president, if he's going to screw around doing things like that, God knows whatever else he's telling me that isn't true. As I said, in our business, it's one word, it's trust. We have over 2,000 clients all around the world. Many of our clients I've never met, but through the internet, and I love the internet. I mean, I can't believe what it can do. We have 2 websites. They're on the sheet here. And as I was telling George at lunch, I picked up a client out of Cairo, Egypt. Now, how did he come to us? We don't advertise. You'll never see an ABC advertisement. But he picked it up on one of the search engines, went in, liked what we're doing, and bought us. The fact is, with instant information, the demand for instant gratification, you're tracked by everyone. And as I tell my guys when we update our website every Friday, I say make sure your English is proper. You never know if it's your grade 10 English teacher going to look at you, or whether it's some other fellow who has $1 million to put in your fund and likes what he's reading. But if there are a lot of mistakes, whether it be typo or improper English, you knock them out. In fact, when I get a research report from a broker, I don't like a 20-page sheet. I like it all on one sheet. In fact, it was Peter Lynch. And by the way, again, you asked me, George, if I read such and such a book. If I had to recommend one book to you people, it's going to sound like blasphemy to this group. And I've read them all. I go to the library and get Peter Lynch's book, One Up on Wall Street. It's written in the vernacular. It's plain simple. He respects his wife, who gave him a lot of ideas. And I listened to my wife a lot. I came home one night after work, and I was pretty glum. One of my stocks imploded. Boom. I walk in the front door, and my wife says to me, "What happened?" I said, "Well, look, one of my stocks is down, and it's bad." She says, "Well, why did you buy it?" Like, you don't buy a stock to deliberately go down. You use the maximum amount of information you can. You have to make a rational decision. There are things that change on you, states of nature, acts of God. Go know there's going to be a tsunami. Go know there's going to be a hurricane, or there's not going to be a hurricane in Florida. These are things you have to learn to live with and roll with the punches. There are no courses on this. In fact, if I had to take one more course to be the capstone of my career, you know what it'd be? It wouldn't be an investment course. It'd be a course in child psychology. Because that's all it is. And we talked a little bit indexing over lunch. I don't believe in indexing. I don't believe it at all. Indexing, in my view, is a cop-out. Why do people index, or why do institutions? They index because they want to be close to some index number. It'll keep them from being fired. And it breeds mediocrity. If we're all going to index, if we're all going to manage big pension fund money and indexing to an index, we're all going to get the same performance. We're all going to look like heroes. If that was the case, what do you need your MBA for? What do you need your CFA? What do you need Mr. Buffett? Mr. Buffett doesn't index, and I'm sure Ben Graham never did. In fact, if indexing is so good, you don't have to hire a fancy, talented management. My 8-year-old daughter can do that. Because all it is, you just plug in a few, tick, 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 and you're there. So I have definite views on that. I do believe the market is imperfect. If you do your homework, and you do need the patience of Job. You buy something, it doesn't happen right away. A lot of people will buy a security at $10, and it closes the day at $9.90. You're off 10 cents. And people flip out. I'm sorry, life doesn't work that way. Sometimes it rains. Sometimes it snows. You have to have the courage of your convictions. What we manage 5 ABC funds. 3 are open-ended. We manage a Canadian balance, and we're in the brochure that I've given you, the ABC perspective, a Canadian equity, and an American value fund. In addition, we manage 2 closed-end funds. ABC North American Deep Value, which can buy anything in North America, ranging from microcap to large cap. So it's an all-cap deep value. We believe, particularly in the United States with the Sarbanes-Oxley Act, that was a legislation that went in about 5 years ago to counteract the Martha Stewarts, the Enrons, the WorldComs. And unfortunately, as you know, quite often when the politicians discover something that's not right, they go too far to the right or too far to the left. Sarbanes-Oxley Act, and in particular Section 404, is killing American companies. They're spending billions of dollars a year, at least 5, 6, 7 billion a year to comply. So what does that mean? To my mind, it presents opportunities. I want to buy small companies that have no business being public, particularly after they've gone public and they're one of that 45% that has no analytical following whatsoever. What's the point of being a public company? In fact, being a public company isn't what it used to be. Whether it's myself or any one of you as president of a public company, You have to be very careful what you say and do. You go to a cocktail party. You have to make sure what you say isn't inside information. In my business, I call it tipper and tippee. I got to watch myself. And I don't mind putting a stock on our website, but after I bought it, then I can open up my kimono. It's my duty to let the world know that I have it. But having said that, you have to be very careful in this business. Keep your eyes open, your ears open, but keep your mouth shut. Now, with our deep value investing style, and you'll have plenty of opportunity for questions, hopefully, we call it our 10 Commandments of Deep Value Investing. I've listed on the front page. What are things that we look for? And by the way, what do I mean by our 10 Commandments of Deep Value Investing? I don't care what you are, whether you be a doctor taking out someone's appendix. You know, you don't go through the right shoulder to take out someone's appendix. There's certain rules and regulations you have to follow. Same thing with my business. So what do we look for? We look for low price earnings multiples. Well, naturally. But at times we'll buy a company with a high P multiple because it's at the bottom of the cycle. Low cash flow multiples. A company may be trading at 2 or 3 times price earnings multiple. However, if you look at the accounts receivable, you see they're not collecting any money. There's no cash flow. That could be the seeds of bankruptcy. Discount to book or net asset value. As I said, when we look at an annual report, we look from right to left. In the notes of the financial, in tiny, tiny little print, and you wonder why they do that. The President's report is always in huge print for you to see, but the tiny, tiny print, the notes of the financials, what are they? Litigation, both favorable and unfavorable. Hidden real estate, tax loss carry forwards, subsidiaries that could be taken public. Give you an example. We found a company out of Newport News, Virginia, called Noland Company. And the Noland Company would distribute compressors and refrigeration products. It had about 100 distribution centers around the United States. Now, the interesting thing was, every time they would outgrow a distribution center which they owned, they would move to another distribution center with more land, and they would sell the old one. And I noticed every quarter they would book an extraordinary gain, because these distribution centers were put together in the 1960s and 70s. The land was worth more. So that got me thinking. We ended up buying the company, which was trading around $33, with a hidden value. Now, there are only 3.5 million shares outstanding. Now, we bought just under 5% of the company. I don't like to go over 5 in the United States because then I have to file with the SEC. In Canada, it's 10%, although occasionally I'll file and go over the 10%. I don't like to telegraph what I'm doing. So what I did, I called the CFO of Noland Company in Newport News, Virginia. I said, by the way, I'd like to introduce myself. My name is Irwin Michael. I'm portfolio manager at ABC Funds. And by the way, I'm not looking to take over your company, but we just bought 4.99% of your company and would like to keep in touch with you, let me know what's going on. I said, I've noticed you have a hidden asset in real estate. He says, yes, we do. And my next question was, and I always take a shot, and I said, do you have any other hidden assets? He said, yes, we do. I call it the mosaic tile theory, the mosaic theory. It's putting together those mosaic tiles to get this big, beautiful picture. So I said, well, tell me. It was my dime. He said, well, do you remember accounting? I said, sure do. He said, we use LIFO accounting. And it didn't click. This is from Accounting 101. LIFO, FIFO, you remember that? Now, the thing that didn't, it didn't register right away. Compressors haven't changed over the years. Refrigeration products. It's not like high tech, it's low tech. The fact was, this company, by using LIFO, had understated their inventory by $28 million. Divide by 3.5 million shares, that was almost $8 a share in hidden value in the company. Whoosh, the lights went on. These are things we look for. Do they teach you this in business school? They may teach you to understand LIFO and FIFO accounting, but no one ever bothers to ask the question or actually look at a company's balance sheet or their annual report from the back to see what type of accounting they use. Okay, 4, hidden assets. Could be anything. Could be the real estate. Fifth, management. Strangely enough, I'll roll with really smart managers. It could be a Frank Stronach, could be any one of the smart guys in the business. But I also like to roll with dummies. There are a lot of people who run companies that aren't too bright. They think they control the company. They own 1%, but they don't control the company. It's you people, the masses who control it, the silent majority who neglects to really vote. So quite often, and a typical example many years ago was Sheridan International. Ian Delaney, who used to be president of Scotia McLeod, went in and with OMERS, Ontario Municipal Retirement System, he went in and had a dissident slate, and they took over the company because the previous managers weren't doing their job. It's democracy. You vote with your dollars. And he took it over, and here it is today. Products and services for 2000 and beyond. Look, you don't want to be buying a company that produces buggy whips. You want a company that's in tune with today. That's why I don't buy very many high-tech companies, because it's high-tech today, low-tech tomorrow. Some 15-year-old kid may be in his father's garage developing a new process for a computer. So the shelf life, in many cases, is pretty low. One of our big wins back in 2000, 1999 to 2000, was a company called Canada Bread. They make Dempster's bread. It went from 40 to 10 bucks. And at that time, I was losing a lot of clients because I refused to buy Nortel. Nortel peaked at 124.5. I refused to buy it all the way up. I was losing clients money. They told me, just like they told Warren Buffett, you're yesterday's man, and you got to get with it. We're in 2000 right now. You can't go by the old ways. Baloney. I was wrong for a while. I bought Canada Bread at 10, went to 8 3/4. 2 years later, I sold it at 25. Sold it too early because it's now at $50 or $60. But the bottom line is, it had a discount to book or breakup. In terms of Nortel, we looked at it at 100. I looked at it at 110. This is before they did the consolidation. And the bottom line was, Nortel, trading at, say, 120, had a book value of $11. Of that book value, 75% was goodwill. And maybe they were going to earn $1. Now, I don't buy a stock trading at 120 times PE multiple. Now, the other thing they did, they bought a company out of California, and they spent, I think it was $1.1 billion. I don't know if you remember, George. And I don't know, within 12 months, they wrote the whole darn thing off, right off. And my question to management was, you just blew $1.1 billion. And what came back to me was, don't worry, we didn't use cash, we used our shares. Well, shares are currency. Shares are your currency. Number 7, a value catalyst. You have to be very careful. We'll find many companies that look dirt cheap. Problem is, they are what we call a value trap. Value trap, you buy them cheap, you sell them cheaper. So you're looking for a catalyst. In the case of Sheridan International, Ian Delaney came in. He took the company to a new level. Discounted valuations compared to peers. You know, the old saying, buy the smallest house on the block and let everyone else yank you up. We tend to buy companies that are smaller cap, that tend not to be followed, that may be trading at 5 or 6 or 7 times PE multiples, when all of their competitors are trading maybe at 20, 30 times. They could be a great accretive acquisition, but they're there. Contrary opinion and underfollowed by investment analysts. I like to go against the pack. We give business to a lot of brokers, but there are a couple I give business to because they're always wrong. And why do I give business to those guys? Because I use them as my contrary indicator. I want to make sure these guys stay in business. I know in particular there's one guy, and you may laugh, but it's the God's honest truth. There's one guy, whenever he calls me, I don't know how he stays in business. It's probably because I still give him business. Whenever he calls me, I've learned to do the opposite. He's the type that'll tell you to buy Nortel at 120 because it's going to 180. Unfortunately, he's looking through a rear view mirror. And the last point is discipline. Discipline, discipline, discipline. I don't care what you are. If you're a value investor, a growth investor, a momentum investor, stick with your style. You can't be a man for all seasons. There are times when I'm in the penalty box. And there are times when I look like a hero. It goes for everyone. So, where do we go from here? I can talk a little bit the economy, and I'll just maybe 10, 15 words, and I want to mention a couple of things. One, I tend to be very optimistic. It's not that I'm looking through rose-colored glasses, but I look at one of the primary factors of production, interest rates. At 3 to 4 to 5% interest rates, it's like an aphrodisiac. That is why you've got big private money and hedge fund money that can borrow money so cheaply. In fact, wait a minute, let me ask you all a question. I'm a nice guy. I'm debt-free. Who will lend me money for 30 years at 5%? I promise I'll pay you back. Anyone here lend me money for 30 years at 5%? Come on, there's got to be. No one here? Why are people falling all over each other to lend money to the banks at 3%, lend money to the government of Canada buying long-term government bonds at 5%? Why? I never thought in my lifetime I would ever see interest rates so low. As an entrepreneur, if I can't make money with my cost of funds at 5%, I shouldn't be in business. I can find you stocks that are yielding 5%, 5, 6, 7% with a capital gain kicker, because we're net asset value buyers. I want to buy you a toonie for a loony. The fact is, if I can get the risk-free rate, if a stock will yield me 3, 4, 5% while I'm waiting, it's terrific. And by the way, when it comes to the income trust market, we're looking maybe at 10. Out of the 300 or so, a lot of them shouldn't be even public. Accidents waiting to happen. We like the REIT market. We just sold all of our legacy hotel REIT, probably a little early, but we made money buying it cheaply when no one wanted it. Royal Host. We're always looking for something new and different. So you've got to be very contrarian. So in terms of the economy, we see relatively stable inflation, and we see Canadian dollar trading within a band. I don't think it's particularly cheap anymore. Our view was the moment it went to 88 to 90 cents, it was expensive. So we were willing to go in unhedged into the U.S. market, where we're finding a lot of our good picks. I believe the U.S. market is the cheapest market in the world for a number of reasons. Americans are very down on themselves. They're fighting a war in Iraq. They don't know how to get out of. You've got President Bush, probably certainly wouldn't win a popularity poll anymore. And you've got to wait a year and a half until you get a new slate of people coming in. Now, it's interesting. This is going to be the first election in many years in the United States. Republican and Democrat, you will not have an incumbent. You're going to have new people coming in who will offer, I think, a lot of positive things. So my Machiavellian mind tells me, you know what? I'm not that bearish. If I can look beyond this valley, I think there's some interesting things. The other thing that's killing the American market is, as I said, the Sarbanes-Oxley Act. I'm surprised Europeans with their overvalued euro dollar or the overvalued British pound don't convert to the US dollar, trading on its rear, to buy US companies, that maybe that 45% that have no analytical following, trading at maybe 50 to 60% or 70% of net asset value. The beauty about the United States is there's no law that says you can't buy out a company there, as long as it's non-strategic. So that excites me. Generally, the earnings numbers have been good, notwithstanding today, what was it, when the high-tech companies had soft earnings outlook. But that's fine. You're going to have a few that aren't going to be doing that well, but you've got to do your research. So by and large, I'm optimistic. Now, I'd like to give you the second page of this, and that's giving you a performance review. Now, I didn't mean to give this to you, but Carlo, one of my fellows, decided to throw this in. And the bottom line is this. Can you roll back to high school? They told you in high school to get good marks. Why? To get into a good university, right? So you bust your butt to get into a good university. You had good marks. You go into university, you get your BBA or BCom or BA, and then you decide you want to go to graduate school. They tell you to have good marks, so you work your butt off. And then you decide you want to go for a job. They tell you better have good marks because the interviewer is going to ask you how you graduated in school and what you did was a cum laude. Not to say it means very much, but it's one thing, it's marks. Well, let me tell you something about life. It doesn't change. This is my report card. I have to have good numbers or else my clients are going to leave me. It's competitive, it's hard work, and it's a 24/7 job. Now, I've told my wife and my kids, because I've got 4, family comes before this. And the moment family is compromised, I leave. I happen to like what I do. I've arranged my work such that I can enjoy my family and at the same time continue with my passion. So the bottom line is performance from here on in doesn't stop after business school. We're proud of our numbers long term. Short term, you can run into bits of traffic here, but if you look at our second fund, Fundamental Value, and that's our big fund, it's a $900 million fund. If you take it right across to the 15-year, it's showing a compound rate of return of 18.24%. Now, as you all know, money doubles at 10% every 7 years. You can imagine what it does at 18. As the first unit holder of the fund with my RSP, forget about owning the joint, it's made me quite well off. And I do this because I happen to enjoy it. Excitement to me is when I find a stock everyone hates, and then it goes up. But more importantly, it's these numbers. We manage money for over 2,000 high net worth people around the world. Our minimum is $150,000. We use an offering memorandum as opposed to a full-blown prospectus. Everything is kept very simple. And I like, it was Peter Lynch's old view, if you can't write it with a crayon, forget it, pass. I don't like 20-page reports, which brings me to our ABC perspective. If you turn to page 3, we've written 2 of our stocks up. Do you have? It's interesting. One is a Canadian stock, the old Canamac, page 3, and the other is John B. Sanfilippo. If you can't do it on a page or half a page, I don't have time. You think Warren Buffett has time to go through a 50-page analysis? Give me the news. Give me the views. I need a synopsis. I don't have time. I get this much every week of crap. A lot of it, as I say, is out of date. And you basically need to be very discerning as to what should be read and what shouldn't. I get over 150 emails a day. And yet, before I click it off for delete, I'm always looking for that little bite of information that could mean the difference between, $1 million position for one of my clients or for one of my funds. So I try not to be too quick to delete. You've got to use all the speed reading, all your skills, like a quick fix. Got to be onto that. So we bought when no one wanted it at around 5 3/4. We saw a great infrastructure play. We saw young Mark Dutil taking it over from his father. Here was a young guy in his middle 30s who had guts and wanted to change it. We did it. My other favorite, and we were wrong for a while, is John B. Sanfilippo. This company was started in 1921 by some Italian immigrants who opened up a nut store, peanuts, almond, cashews, in downtown Chicago. And they've grown that company into what it is today. It's the second largest purveyor of packaged nuts, peanuts, almonds, whatever, in the United States. You know what the biggest one is? Planters, owned by one of the majors. In Canada, you may not see the Sanfilippo name. You'll see Fisher Products, Fisher Peanuts. That's them. These are 2 names that were not very well followed. When Nesbitt Burns decided to do a financing for Can-Am, small little ABC funds was the lead order. And in terms of John B. Sanfilippo, we bought it very quietly. We bought 4.99%, and then we put it on our website. You know what? I may open up to questions because you know what? If you don't stop me now, man, I'm going. I'm just going to keep on going. And I guess if it doesn't, the passion doesn't show on my sleeve, it never will.